With the recent mini pullback in the market, and especially in a couple of sectors, with the rise in fears of no rate cuts this year, higher inflation going to stay high for longer, lots of people are de-risking their portfolios. We started the year quite strong with a lot of tech stocks, growth stocks, you name it, going up and up and up. The overall market has done quite well as well. In the last couple of weeks, we have seen some de-risking happening. Of course, there's also geopolitical issues, etc., etc. So all of that together obviously doesn't paint the greatest of pictures. And so this presents long-term investors with, of course, a great opportunity. Now, just because I make this video today doesn't mean you have to buy any stock on Monday. No, the buying aspect is up to you. How much you're buying, if you're adding to an existing position, at what price, are you going to wait for valuation to come down even more? Are you going to wait for the earnings report, earnings call? Because as we enter the earnings season, you're going to get a lot of information, not just on the companies that you're looking at, but on the companies that are in these similar sectors as well. A very important thing to note. So just because these are two companies I think you should buy and hold forever, doesn't mean that there aren't other companies that you should buy and own forever, and doesn't mean that you should buy as soon as possible. No, do it at your own pace, dollar cost average, or even if you own it already in your portfolio, looking at better entry points. Actually, averaging up is also a tactic, by the way, for long-term investors, because as the business becomes better and better, yes, the stock will also go up and up and up. That doesn't mean that you should stop buying stocks, shares of great companies. Now, in this video specifically, yes, those two companies happen to be in the same sector. Surprise, surprise. But in my opinion, those are two companies that operate in a monopoly type of environment. And that's one of the main reasons why I do think that these are truly buy and hold forever companies. Of course, do share your picks down in the comment section below. And if you own one of those two companies, let me know as well in the comment section below. If you enjoy this type of videos, leave it a thumbs up, subscribe. If you have not, we really appreciate that. We're very close to 40,000 subscribers. So thank you very much for all the support. If you want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So company number one is not an American company. It's a European one in the Netherlands, one you should definitely know very, very well by now. And that's ASML. ASML is in the semiconductor sector. Now, more recently, ASML did report earnings. Although the numbers were okay for the quarter, met their own guidance, it was a bit weak-ish for the market. Guidance, again, as we've known from before, 2024 is going to be a flat year. I don't know why people were surprised by it, because they did tell us that 3 months earlier in the previous earnings call. But okay, I mean, if you could get this great company at a cheaper price, why not? It is true that still right now, forward PE, EV to EBITDA, price to sales, it is more expensive than its 5-year mean. If you want to know the exact number, forward PE 36.9 times, EV to EBITDA 29.1 times, price to sales 10.6 times, price to free cash flow, that's in the last 12-month metric, 133.5 times. Of course, that's because of the recent weakness that we've seen. So that takes a hit. Price earnings to growth ratio 1.72. This is a company that is not only a growth company, but is a company that is doing buybacks and paying a small dividend. The dividend yield right now sits at 0.65%. If we look at the shares outstanding in the last 10 years, those have come down by around 10%. With regards to the dividend, although a small dividend yield, you can see that in the last 10 years, the annualized growth sits at 22.5%. Even in the last 5 or 3 years, it's above 15%. So quite a lot of growth there, quite a lot of repayment towards shareholders, not just for the stock's appreciation, but even if the stock doesn't appreciate, this company is making sure that shareholders do get rewarded. Now, as I said, the surprise for the guidance shouldn't have been a surprise, because if we go back to Q4 earnings call, they said the following. To be able to follow the curve of the industry recovery, we are looking at the combined demand for 2024 and 2025. As I mentioned last quarter, we fueled 2024 as a transition year in preparation with the expected strong demand in 2025. We therefore continue to make investments this year, both in capacity ramp and in technology, to be ready for the upturn in the cycle. They said here, previously communicated expectations of 2024 revenue to be similar to 2023. And by the way, since this quarter, sales are down year over year. They still expect overall revenue for the year to be flat compared to 2023. That means that the next coming quarters are going to be quite strong. We also know that semiconductor industry is a cyclical industry, but as always, we have to look at the backlog here for ASML. At the end of Q1 2024, they finished with a backlog of around 38 billion euros. Of course, yes, with cycles, you have up cycles, down cycles. But when you have such a big backlog, you know that you're going to be busy no matter what. They also provided a bit more color with regards to the long term. So while there are still significant uncertainties, primarily driven by the macro environment, it appears we are passing through the bottom of this specific cycle, and we expect an industry recovery over the course of 2024. Based on the discussion with our customers and supporting our strong backlog, we expect 2025 to be a strong year driven by a number of factors as mentioned last quarter. And so despite the, let's say, weakish numbers for this quarter, as the CEO said here, first quarter total net sales came in at 5.3 billion euros at the midpoint of their guidance, with a gross margin of 51%, which is above guidance, primarily driven by product mix and one-offs. They expect second quarter total net sales between 5.7 and 6.2 billion euros with a gross margin between 50 to 51%. ASML expects R&D costs of around 1 billion euros and SG&A costs of around 295 million euros. If we look at the breakdown, so the net system sales breakdown, the technology, the end use and region, more specifically, I want to focus on end use and region. End use, you can see memory 37%, logic 63%. Same thing last year. But then if you look at region, huge jump here for China. Previous quarter, 39% in China. Now it's 49% China. Taiwan is now 6%, previously 13%. South Korea 19%, previously 25%. USA went from 11% in Q4 to now just 6%. Of course, China, we know US-China tensions, Taiwan tensions, etc., something to keep an eye on. But as a lot of companies are starting to, let's say, diversify their investments around the globe with regards to semiconductors, we know TSMC, Intel, Samsung, they're all wanting to build infrastructure around the globe, more specifically also in the United States. Of course, they're going to need equipment from ASML. So in my opinion, the future is quite bright for this company, especially since, well, it's a monopoly. Now, with regards to this stock, of course, on the weekly, a huge red candle. We're now under the 50 and a 20-day moving average. As I said in the previous video, $800, which is around the 200-day moving average, is going to look quite attractive if we manage to reach that area. Then, of course, if we break under that, then I would say the bottom from the previous times was around 600, which of course would be quite a gift. So that was company number one. Company number two, like I said, also in the semiconductor industry, and that's another pretty powerful company, very important for the whole ecosystem, and that's also why it is on the buy and hold forever list. That's Taiwan Semiconductor. Now, they as well have reported earnings more recently. We're going to have a look and read a couple of comments that were mentioned during the call. A good quarter, good outlook as well. Some weakness around the semiconductor industry in the last couple of days. As we discussed on Friday, SMCI did not pre-announce their earnings. Well, not their all earnings, but some of the numbers. Market thought this was, or still thinks this is a negative. All the chips went down. Maybe sentiment around AI semiconductors are coming down as well. Plus there is, like I said, a de-risking happening right now. So all the sectors are getting affected. But this is when you can get great opportunities. So TSM, right now, it is cheaper than its 5-year mean, thanks to the recent pullback. Not by a lot, but if you look at forward price to earnings, EV to EBITDA, price to sales, price to free cash flow, we're all under that 5-year mean. By the way, this is on Coifin. There is a link down in the description and in the pinned comment for you to try out. And there is also a 20% off. Price earnings to growth sits at 1.12, which in my opinion, quite attractive for such a strong company. Now I want to start with some comment in the earnings call. So they say here almost all the AI innovators are working with TSMC to address the insatiable AI-related demand for energy-efficient computing power. We forecast the revenue contribution from several AI processors to more than double this year and account for low teens % of our total revenue in 2024. For the next 5 years, we forecast it to grow at 50% CAGR and increase to higher than 20% of our revenue by 2028. Then if we look at the results for Q1, net revenue came in at $18.87 billion. That's up 12.9% year over year, but down 3.8% quarter over quarter, beat the high end of their own guidance. Gross margin 53.1%, in their guidance a bit down 3.2 percentage points year over year. Operating margin 42%, same results. Net profit margin 38%, flat quarter over quarter, but down 2.7 percentage points year over year. Now, if we look at the revenue per technology, again, this quarter, 5 nanometer taking the majority or the largest part, 37%, 7 nanometers, 19%, and the 3 nanometers, which is the newest one, 9%. As you can see here, last quarter, 3 nanometers, really a big push there, but they're quite confident on the growth for the 3 nanometer. With regards to revenue by platform, HPC 46%, smartphone 38%, despite some seasonality, some weakness there. Growth here, quarter over quarter, is down 16%. And as they say here, moving into second quarter 2024, they expect the business to be supported by strong demand for their industry-leading 3 nanometer and 5 nanometer technologies, partially offset by continued smartphone seasonality. For the second quarter, they expect revenue to be between $19.6 to $20.4 billion, with gross profit margin to be expected between 51 to 53%. Operating profit margin is expected to be between 40 and 42%. And now looking at the stock, a bit of the same story as with ASML. It's under the 50 and the 20-day moving average. The 200-day one sits at $112.3. Again, if we can reach those areas, I think it's going to be looking quite attractive for, again, this dominant company. Now, why did I choose both of these companies in the semiconductor industry? Because it is my belief that in the future, there is going to be a need for more and more chips, more and more semiconductors, since every aspect of our lives, of our daily lives, is going to be, let's say, electrified or in some sort, right? AI is going to go up, autonomous vehicles, robots, phones, wearables, you name it. So you need more and more chips. As the world starts to diversify the supply chain for semiconductors, I think companies like TSMC and ASML are going to be of extreme importance. And as we've seen, there are plenty of competitors, right, in the chip making industry, chip designing industry. Every hyperscaler is starting to design their chips. You got NVIDIA, AMD, ARM, Apple, Amazon, Meta, Intel, you name it. One thing they all have in common is that one step beforehand, you need companies like TSM. And TSM needs companies like ASML. Plus you have, of course, Lam Research and some other companies out there as well. But this is the important part. You want to pick companies to buy and hold forever because you don't really care what happens in the short term. You want to have the strongest possible companies in, well, in this case, in a monopoly type of environment that can handle ups and downs, ups and downs. And so to end this, price, entry price is, of course, important. So dollar cost average, you don't have to buy all at once. I do think that we're going to get quite some opportunities in the next coming weeks, maybe even months. So that will be it for this video. Of course, do share your thoughts down in the comment section below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye-bye.